Now that we know what Medicare and Asti are, let's talk about how they are taxed. And we're going to start with a more complicated one, Asti, also known, of course, as Social Security. So we're going to find out that there is a limit on the amount of Social Security tax that an employee can pay in a calendar year. So the maximum dollar amount of earnings, in other words, gross pay, that can be taxed per employee per calendar year is called the wage base. There will be other taxes, notably FUTA and SUTA, that also have a wage base, but it's much smaller than Asti. So in our homework, we're going to assume that the Asti tax rate is 6.2%, but we're only going to tax our employees on their first $102,000 of gross wages per calendar year. In other words, if someone made $110,000 in a year, only the first $102,000 would be taxed for Asti. Now we're going to assume that the Asti wage base, or the taxable maximum, in other words, is $102,000. In reality, that number often changes, and it is not a nice round number. So we're just going to use this nice round number to make our math easier. So what I want you to do now is calculate the maximum amount of Asti tax that an employee can pay in a year. So go ahead, pause the video, and actually calculate. What's the maximum that any of your employees would pay in a year for Asti? Because your job in payroll is to make sure that no one pays more than that. So to calculate that, you're going to take the $102,000 maximum times 6.2%, and that gives us $6,324. Again, that's the maximum amount that one employee could pay into Asti, Social Security, in a calendar year. And it's your job to make sure that no one pays more than that. And we do that by monitoring an employee's year-to-date gross pay, so that once they get to the $102,000, we will make sure that they no longer pay Asti. So there's two ways to calculate an employee's amount of gross pay that's going to be taxable for Asti. The first method is the one that I prefer because I'm visual, and it's just using a handwritten graph. Method 2 is using a flowchart. This flowchart is more the way that a calculator, or not a calculator, is more the way a computer program would think. Also, if you're going to use Excel for the payroll project, which is optional, you don't have to use Excel for the payroll project, you could use this flowchart to monitor your employees so that to make sure that they are not paying more than the maximum amount of Asti in a year. So here's method 1. We're going to use a graph to calculate how much of an employee's gross pay is taxable for Social Security. So what this graph is showing is cumulative gross pay. In other words, year-to-date gross pay. And the person we're talking about is Sophia. So we're going to do Sophia's first 3 paychecks. So we need to know our wage base. The Asti wage base is $102,000. So now what amount is taxable for each employee? Is it the gross pay under or above the $102,000? A lot of students get this confused. That's why I'm asking this question explicitly. The amount that is taxable for each employee is the amount from $0 of gross pay up to $102,000. So it's the amount under the $102,000 that's taxable. Once their gross pay reaches above that, we can no longer tax them for Social Security. So here's a scenario. This is paycheck 1 for Sophia. She makes a lot of money. Her first paycheck is $50,000. So our first question, what's the taxable amount for Asti in paycheck 1? Now we're not talking about the tax. We're just talking about how much of that $50,000 is taxable. Well, the taxable amount is gross pay below the $102,000. So in other words, since her gross pay is still under the $102,000 wage base, all of her gross pay is taxable. So go ahead and calculate how much is her actual OASDI tax going to be on paycheck 1. Well, to calculate that, you're going to take the taxable amount, $50,000 of gross pay, times 6.2%, gives us $3,100 in OASDI tax. So from Sophia's paycheck, we're going to withhold $3,100 for OASDI tax. Okay, now it's paycheck 2. Again, she makes $50,000. It must be nice to be Sophia. So our question again is, how much of that $50,000 is taxable for OASDI? So what's the taxable amount for OASDI in paycheck 2? Well, it's the amount of paycheck 2 that is below the $102,000. All of it is below the $102,000 maximum. So all of the $50,000 is taxable for Sophia in paycheck 2. So then we go ahead and calculate again, how much is her OASDI tax? Well, it's just $50,000 taxable times 6.2% gives us $3,100. So in her first 2 paychecks, she's paid a total of $6,200 in OASDI tax. Notice she's getting close to the wage base of $102,000. So now this is where things get a little bit more complicated. It's paycheck 3. Sophia's still raking in the cash. She gets paid $50,000 gross pay in paycheck 3. The question again is, what's the taxable amount for OASDI in paycheck 3? Again, we're just looking for the taxable amount first, not the tax itself. So how much of that $50,000 is taxable? Well, it's the amount of that paycheck 3 that's below the $102,000. So how much of that paycheck 3 is below the $102,000? So it's this little green area. The taxable amount is gross pay below $102,000. So taxable amount is $2,000. How did we calculate that? You take the wage base, $102,000, because that's the maximum, and we subtract her year-to-date gross pay of $100,000. So in other words, we've already taxed the $100,000 before that. So in paycheck 3, we're only going to tax the amount from $100,000 up to the $102,000 wage base. So the taxable amount is $2,000 for paycheck 3. And then now we have to calculate, well, how much is her actual tax for paycheck 3? To calculate that, it's the taxable amount, $2,000, times 6.2%, gives us $124 of OASDI tax. And as a bonus question, what would her OASDI tax be for paycheck 4? Well, in paycheck 4, she's already exceeded the $102,000 limit, so there's no OASDI tax for her paycheck 4. And then if you add up the amount that she has paid in OASDI tax, the $3,100 in paycheck 1, $3,100 in paycheck 2, and the $124 in paycheck 3, then she has equaled the maximum amount that you can tax an employee, which we found out was $6,324. So that's the visual method to calculate how much is taxable for OASDI. There is also the flow chart method. So this is method 2 if you prefer. And this might be nice to use if you're trying to program Excel to calculate this for you, which once you get it right, it's super handy because then you don't have to do it anymore. So let's go through the 3 same scenarios. So example 1, first paycheck of the year. Sophia's year-to-date gross pay is 0. So on paycheck 1, she has no year-to-date gross pay before this, so that's 0. Her first paycheck, the gross pay is $50,000. And remember, the OASDI wage base is $102,000. And notice in this box up here, it says to start, you need the year-to-date gross pay, which we have, 0. You need the gross pay for this paycheck, $50,000, and you need to know the Social Security or OASDI wage base. So the first question in this triangle is the employee, remember EE stands for employee, is employee's year-to-date gross pay prior to this pay period greater than the OASDI wage base? So it's asking, is the gross pay before this paycheck, which is 0, greater than the wage base of $102,000? No. So we're going to go down here to this next box, or next decision box, I guess is what it's called. Is the year-to-date gross pay, which is 0, plus this pay period's gross pay, $50,000. So is 0 plus $50,000 less than or equal to the OASDI wage base? Yes, $50,000 is less than the wage base. So we go this way, yes. And then this box says all of the employees' gross pay for this paycheck is taxable. So in other words, $50,000 is taxable for her first paycheck. And then to calculate the actual tax, you just take the $50,000 taxable amount times 6.2%. In the second paycheck, her gross pay is $50,000. I should say her year-to-date gross pay. In other words, prior to this paycheck, she's been paid $50,000. This paycheck is also $50,000, and remember the wage base is still $102,000. So we're going to go to our first decision box. Is the employee's year-to-date gross pay, $50,000, greater than the OASDI wage base of $102,000? So no, $50,000 is not greater than $102,000. So we go down here. It says, is the year-to-date gross pay plus this pay period's gross pay. So in other words, $50,000 plus $50,000, that's $100,000. Is that less than the OASDI wage base? The answer is yes. So all of the employees' gross pay for this paycheck is taxable. So for paycheck 2, it's still $50,000 taxable for OASDI. Now we get to that third scenario where we're going to go over the limit. So as a reminder, Sophia's year-to-date gross pay so far is $50,000, because remember, we're working on the third paycheck here. Sophia's gross pay for paycheck 3 is still $50,000. So let's look at this first box. Is the employee's year-to-date gross pay, $100,000, greater than the wage base? No. So we go down to our second decision box. Is the year-to-date gross pay plus this pay period's gross pay, so $100,000 year-to-date, plus $50,000, so it's $150,000. Is it less than the wage base? No. So we're going to go over here. It is not less than $102,000. So the employee's taxable amount for OASDI equals the OASDI wage base, $102,000, minus the year-to-date gross pay of $100,000. So $102,000 minus $100,000 gives us $2,000 taxable. And then let's do the bonus round on her fourth paycheck. Sophia's year-to-date gross pay is $150,000. So let's look at the first decision tree. It says, is employee's year-to-date gross pay prior to this pay period, in other words, the $150,000, is it greater than the wage base, $102,000? So yes, $150,000 is greater than $102,000. So we're going to go over here to the yes. And that answer is none of the employee's gross pay is taxable for OASDI this period. So 0 is taxable for that paycheck and for the rest of the year. So now let's talk about Medicare, also known as hospital insurance, sometimes called HI. So this book is going to be assuming that all wages are subject to Medicare. So there is no wage base, which means there's no maximum. So what this means to you in payroll is you're going to like calculating Medicare better than you're going to like calculating OASDI, because Medicare has no limit. So you don't have to worry about any limit. So the rate we're going to assume is 1.45% of an employee's gross pay. Now we're going to move on to other potential withholdings. Potential means there might be some of these withholdings. There might not be. So these are not mandatory withholdings. An employee might have something taken out, an amount taken out of their paycheck to pay for medical insurance. If so, that's a withholding. That's a deduction. They also could have a savings plan. They might have $50 taken out of every paycheck and sent automatically to their credit union's savings account. So that would be another deduction. They could have optional disability insurance. The college has this, long-term disability insurance. If an employee is a member of a union and has to pay to be a member of the union, those are called union dues. Those might be, those are probably going to be withheld directly from the paycheck. They might even have a gym membership. When I worked in payroll, we had a deal with the local Redmond Athletic Club, and if our employees had their gym membership taken directly out of their paycheck, they got a big discount on Redmond Athletic Club. And some people will optionally have money taken out of their paycheck and given to the church or some charity. And there could be lots of others, like a individual retirement account, an IRA, 401k. Those are retirement plans. Okay, so there could be lots of different withholdings, and each employee's could be different from other employees because some of these, as we see, are optional. So let's talk about some more vocabulary. Let's figure out what net pay is. Net pay it's the amount of your paycheck after all deductions, mandatory deductions and voluntary deductions. People a lot of times will call this take-home pay because that's the actual pay that they take home or is deposited in their bank because most people have direct deposit anymore. So let's figure out what the net pay formula is. To calculate someone's net pay, in other words, their take-home pay, we're going to start with gross earnings. And then we're going to deduct the mandatory withholdings, starting with federal income tax, state income tax, if that state has one, Asti tax, Social Security, and Medicare tax. Those are all mandatory taxes that must be taken out from an employee's pay. And there could be other withholdings too, like the medical, the charity, the union dues, the retirement accounts, like a 401k, etc. And then once you subtract all those deductions, that gives us net pay. And that's it for this lecture.